Hi, this is Jack from Alpha Charts with a state of the market video. Today is August 8th, 2020. Before we get started, this video is for educational purposes only. These are not recommendations to buy, sell, or hold any stock or security, and I may hold positions in some of the equities mentioned. Know your time frame and risk tolerance. Also, if you enjoy these videos, I appreciate any likes and subscribes. And if you're on Twitter, retweets would be appreciated. Thank you. All right, so we're going to start with the S&P 500 here, and we're going to go a little more in depth into the S&P and some of the other indexes. So as you can see, we are coming back up to all-time highs again, right? We're just a smidge underneath all-time highs, which were back in February. So this would be an area that could potentially cause a little bit of resistance right here. That's a possibility, but you see the trend is still higher, right? We're still making, higher highs and higher lows and above rising, 9-day and 23-day, and I could, and every other moving average, right? They're all rising again. So what I want to do here is I want to talk about what makes up the SPX. So I went ahead and pulled up the S&P from the iShares, and as you can see, it is a weighted average, and Apple is the highest weight, Microsoft, Amazon, Facebook, Google. Those make up roughly, let's say 11, 12, 13, 23, 24% or so roughly of the index. So they are the heavyweights, right? The FANG stocks plus Microsoft. But let's look at by sector. So by sector, you'll see information technology is 28%, healthcare is 14%, discretionary is 11%, communications and financials is 10%. Everything underneath that is much lower, with energy way down here, materials. I mean, they're just tiny smidges. These, even if they explode higher, won't move the index, right? So these are the sectors, these top 2, 4, we'll call them 6 sectors, are what is going to move the index. And with information technology being the biggest one, and as you can see, Apple and Microsoft are the big boys in that 11 or 12.5% or so of the S&P are these two companies. So when you buy the SPX, that's what you're buying, right? You're buying, 12% of it is Apple and Microsoft. So what we can do is we can actually look at the equal weighted S&P. So you see SPX right now is just a hair under all-time highs. But when you look at the equal weight, we're not there yet, right? We are still a good bit away from all-time highs. We'll say we're roughly, 8.5%, 9% away from all-time highs. So those mega cap stocks are doing very, very well. Maybe, but when you look at the equal weight, it shows that maybe some, what should we say? Some breath under the surface isn't quite there yet. Now, is it encouraging? Absolutely. Is it an uptrend? Yes. Is that good for the market? Absolutely. But we're not there yet. So you see the driver of the market, in my opinion, is these mega cap names right now. And that's not necessarily a bad thing. We just have to know where the risk is, right? If these start to break down, then there's risk there. So that is a much different look than this right here. So any pullback in here, and that would be kind of expected within the context of an uptrend. Let's look at Qs now. So the Qs, they're way above this channel. They kind of tested the channel and they moved higher above all moving averages. I will be removing these channel lines pretty soon unless we get some kind of major breakdown, because they are no longer relevant, in my opinion, as long as we keep moving higher here. Some distribution here on Friday. Okay, that's not a game changer. We're not seeing huge clusters of distribution right now. There's a little bit in here, but nothing crazy. Again, these moving averages would have to flatten out and turn lower for me to get bearish right now, and they're not doing that, right? I mean, here you had a chance for it, and just rebounded right away. Never crossed, never gave a signal to be bearish. So that is looking real good. Now, if you look at the equal weight QQQ, it looks actually very similar. So that just shows you that the breadth in the Qs is across the board. Everyone's buying technology because not only are the big boys, and we'll look over here. Let me just pull this up. So you see, information technology is 48.4% of the Qs, right? And communication is almost another 20%. Discretionary is 18%. And when the breakdown of companies, I mean, you're seeing Apple, Microsoft, Amazon, Facebook, Google, right? Those guys is 40, what was that, 30, 35, 40, 47, almost 50%. Almost 50% is made up of these, 2, 4, 6 stocks. So as these stocks go, the Qs will go. But the equal weight looks very similar to the regular Qs. So what does that tell you? That tells you that the breadth of technology in general and the Qs is very good, much better than the S&P. And it's a completely different makeup. You don't see financials in here, do you? In the S&P, you saw technology, healthcare was 14%. Here, healthcare is only 6.9%. Again, healthcare has been doing good, but my point is, it's a completely different makeup. Very much tech heavy, as you already know. Utilities is 0.65 here. Utilities is 3%, right? So again, completely different makeup, but that's why the equal weight looks just like the regular Qs. All right, and let's look at the IWM. Now, the IWM is actually made up completely different because IWM is an equal weight index, right? And a lot of these companies you may not have heard of or may not be too familiar with. You may know Penn National Gaming, you may know Sunrun, but you may know Deckers, but you may not know all of these names. And again, it's an equal weight index, but on the breakdown, healthcare is now the leader, financials is second, then industrials, infotech, consumer discretionaries, right? So you see healthcare and financials lead, and when we look at the index, it's not near all-time highs. It is, let me guess, about 9.5, 10%, 9 to 10% away from all-time highs. But we are seeing a nice rotation up, which brings me to my next point, is that are we seeing rotation? Healthcare has been pretty good, but maybe financials are, maybe some rotation to financials to give this a boost. So let's go ahead and look at that, because again, IWM is rotating up, looking good so far. So looking at financials, you saw a huge day on Friday. So where we saw distribution in the Qs in financials, what we saw a nice accumulation day. So are we seeing money move from technology into XLF? Maybe. We are still way far below. It could also be some kind of rebalancing going on too. Maybe funds got too overweight and they just need to rebalance a little bit. We're still 24% away from the highs, to even test the highs. So there is room here for XLF to run. And when we look at XLF compared to the SPX, let's go to line chart. Let's get rid of that volume because I don't like that. And we'll go weekly. Okay. So when we look at this chart, and here's what I post on Twitter, which I think is pretty neat. And we can even do daily here. That's fine. It'll show the same thing. All right. So here it is. 2009 lows right here. Here's the low right here, right? We went lower. We broke down. We came back up. We made a higher low. That's a beautiful thing. And when we look at the relative strength index, which I don't check out all the time, but I do on ratio charts sometime, look at this. I mean, so if this is not a setup right here, you know, with a great risk reward, I'm not sure what is. You know, if XLF versus the SPY breaks back down, you're out. But I mean, it just says that money could be rotating into XLF, right? So you have there's your divergence, right? Right there. You got a big divergence right there. Money could be rotating back in, and maybe we get some kind of big spike up in financials over the short to medium term. It's a possibility, and I think the setup is there. So this is probably right now my most interesting chart as far as things happening in the market. You know, a potential maybe rebalancing or just, you know, a short-term run for financials. And again, they are kind of beaten up, right? Looking at XLF, you know, they're beaten up. You know, you look at the different, you know, sectors, you know, you look at regional banks, you know, they got a, you know, they're just beaten up as hell. Get rid of this. You know, you could look at HYG, broker dealers, I'm sorry, financial services. You see that these look a little bit better, right, than the regionals. These are the big boys. You know, the Bank of America's, JP Morgan's, the, you know, American Express, Citigroup, Goldman Sachs, whatever. Those are the big boys, right? And this is, you know, there's your 2007 highs right here. Boom, test it, false breakout, big breakdown. Now we'll be watching to see what goes on here. But a move to financials, and I think these could potentially test, you know, this area right here, the 140, 141 area. Again, that's IYG. All right. So we looked at XLF, we looked at XLF versus SPX. Let's look at the semiconductors. We're still on the weekly chart here, and you can see, I mean, just beautiful uptrend. Yeah, let's go to the daily, drill down. You know, and this uptrend is intact. You know, price is still above all rising moving averages, right near all-time highs. Even with the most recent little bit of turbulence on Friday, you know, there's not a reason yet, in my opinion, to be overly cautious. Are there some issues in the stock market? Sure. But there's always issues in the stock market, and that's the thing. So we always find a reason to be, the bears will always have a case for something, right? We can always find a reason to be bullish. We always find a reason to be bearish. Right now, I don't see that many reasons to be bearish at all. I mean, we're still a nice uptrend at SMH. That looks good. Looking at lumber, still making, you know, higher highs and higher lows. I mean, everything is looking fine in lumber. Looking at SPX versus TLT. There's a line chart there. You know, breakout kind of came back. TLT had its little run here, and things look to be rotating up again. Again, this ratio is above the moving averages. Everything looks great there. So let's talk about bonds. We're going to go a little deeper into bonds. I'm not a bond expert. I'm not an expert on anything really. But let's just look at where TLT is right here. As far as this chart goes, you know, we had the big run up in March, right? The rush into bonds. And now we are back here and we tested this area again and we backed off from it. So the question is our rates going to go lower, right? And then the bonds could, you know, break out and move higher. Is there another reason to rush back into bonds to cause the breakout? Or are bonds about to start falling down and rates will be going higher? We don't know. So basically bonds break out, rates go lower because they're inversely correlated, or bonds go down and rates go up. Right now, I think in the short term, you know, we hit some resistance. So maybe see a little wiggle in rates. But this is the area to watch, right? Because, you know, a breakout here and rates are going, you know, I mean, maybe negative. Who knows, right? We don't know. But that would be really, really bad for, you know, the economy and the market overall if you're seeing people, you know, rushing back into bonds again and we see a breakout here. So let's look at the 10-year. This is the yield on the 10-year, okay? Speaking of rates, here's the yield, and let's just zoom out real fast so you can see that this is for 40 years, rates have been falling, right? And literally since 2018, they've gone straight down, right? So we could say that bonds are a very crowded trade from this chart, in my opinion, because people have rushed into bonds big time since 2018, right? End of 2018. Yeah, so that's ridiculous, right? And it's a ridiculous move right there in yields. So let us go and look at, again, the relative strength index. And this is kind of interesting. So as we're making new lows, right, in yield, we're seeing, momentum divergence, right? So there's your momentum divergence. What does that mean? Well, right now it means nothing, right? But it may mean that we see yields start to rise again, which would be negatively correlated to bonds, and bonds would be falling at this point. So I think this is, again, something to watch, something to be aware of. Again, if yields are rising, right, bonds are falling. And I think that's bullish for the stock market. Well, I can't say it's bullish for the stock market. I think that depending on how much they rise, basically if they just kind of wiggle in this area and go sideways, I think that would be fine. I think a big spike in yields would be very negative for the stock market. So I just wanted to make that aware of that. So again, a big spike in yields, that would be negative for the stock market. So we got to watch that and see what's going on there. But this is, again, the 10-year yield. And then let's look at high yields, right? And things look absolutely fine in high yields. Things are making higher highs and higher lows. That's the weekly, which is fine too. But you see it on the daily. Higher highs, higher lows. Everything looks pretty good there. Nothing really to see here. High yield looks really good. Then we're going to look at the bond spreads. Okay, a lot of bonds today. Here's the bond spreads, and we're going to zoom in, and we're going to get rid of this because I don't like that. And what do we see here? Right now, HYG. Thank you. All right. So as of right now, we're still making, lower highs and lower lows, trying to make a lower low here. We'll see what happens. Moving averages are declining. We're not, we haven't busted back above that. Again, narrowing of spreads is a bullish sign for the stock market. So I think that is looking okay so far. The VIX continues to fall. We're underneath this threshold now. That's a beautiful thing. So even with the turbulence in the stock market, we're still declining on the VIX. So again, that's a bullish sign right there. Put call ratio, we remain in a bullish range right here. That's still a bullish range. So nothing to see here. Again, I think that these are better signals, and we can stay in bullish ranges for a pretty long period of time. So that's fine. We're going to get wiggles. We're going to get snapbacks and pullbacks, and that's just kind of part of how this thing works. Value line geometric index looking fine. So again, another breadth measure, and things are, things were up on Friday, right? We got a nice little rotation up. Things look really good. So what does this all mean? Well, I think we got to watch the bond market. I think, a big spike in rates would be negative. And is it possible? Sure, it's possible. I mean, the Fed doesn't want that, but sometimes, they're a big unwind in bonds, and they may not be able to control that. So also I think something that we talked about was, as the leaders go, Microsoft, Apple, Amazon. Helps if I can type today. All right, Amazon, Google, Facebook. As the leaders go, the market's going to run with it. So I think we have definitely now more than ever, we need to watch those 5 big stocks out there. And I think we need to be careful of some of the darlings that were out there. Fastly took a huge hit. T-Doc, huge hit. They announced a merger with Livongo, or they bought out Livongo, whatever. Livongo took a big hit. Who else? DocuSign. DocuSign kind of held up pretty good. Took a little bit of a hit, actually. Took a little bit of a hit. Even software MongoDB, big hit. Again, is it broken? Well, it's below moving averages, so I'm not interested in it. But if it falls below this 180, 181 area, that would be a much more significant breakdown. Right now, we'll call this range bound, right? We have lower highs. I consider this range bound. So, we have to be careful with some of these stocks that were, huge movers, right? I mean, MongoDB went from, the lows to the highs, 158%. And so maybe it needs to, this looks to me like more of a consolidation. And that would be my line that, 180-ish, that I'd be much more concerned about. So know your levels, know what you're buying, know how these indexes, how they're weighted, so how that they're going to react to the weighting. And last thing, watch XLF. Watch maybe for some rotation into financials. I think that there's a good possibility for that. So that's what I have for you today. Hope you all got something from this. Leave me any comments and likes on my YouTube page. I'll be posting this on Twitter. Again, likes and retweets are appreciated. Hope you all have a great day and a great week. Stay safe out there.